Hello students. So let's start with the last topic of our module 11, that is asset pricing model. In this module we are talking about the last chapter, that is behavioral finance. So I think it's a common term now and everyone heard about it. So what are the contents I am going to cover under this particular lecture? That is history of behavioral finance, or we can say the evolution of behavioral finance. Then what is basically the behavioral finance, the themes of behavioral finance, standard versus behavioral finance, and lastly we talk about the behavioral biases. So when we talk about behavioral finance, it's not a new concept that we are hearing. It's already an old age concept that is already available in 17th and 18th century. Researchers, or we can say the writers of psychology, have already written some articles and books on the psychology of crowd, or the way the investors are behaving in the market. So this topic already is emerged in 17th century, but it gets formalized in 1990s by the fathers, we can say the behavioral finance fathers, Daniel Kahneman and Amos Tversky. So let's go through the history. So during 90s, I already mentioned that the field has emerged by two behavioral economist scientists, that is Daniel Kahneman and Amos Tversky. What they have done, they have published or gone through certain papers that have been published in last 150 years. On the basis of their research, they identified that market is not rational as propounded by the standard finance. When we talk about standard finance, it comprises of two major components, that is Markowitz portfolio theory and efficient market hypothesis, because these two theories are quite popular in context of standard finance. So according to them, whatever is propounded by these two theories are not exactly happening in the market. So there are certain things which are not or cannot be covered under this particular theories. So what is that? That is the psychology or the way the investors are behaving in the markets. So why they are behaving? Because efficient market hypothesis already said that investors are rational, they should behave in a particular proper manner, their markets are perfect. So in reality, the markets are not perfect and investors are also not behaving rationally, although we can say investors are either normal or irrational. That's why there are bubbles, crashes, panics and manias in the stock market. So there are several books I already mentioned in 18th and 19th century which talked about this particular concept, and in 1841 the first formal book that has been published which study the psychology is known as the delusions and madness of crowd. In this chronological line, the particular author tried to provide the various incidences that have taken place during that particular time period. The next book is Lee Bond's important work, that is The Crowd, a study of popular mind. It discusses the roles of crowd, also known as the crowd psychology, how the crowd behave and what is the group behavior, as they apply to the fields of behavioral finance, social psychology or sociology, as well as in history. So these two books are very important. Another book that is important in this context is written by Sheldon in 1912. It's termed as Psychology of Stock Market, which one of the most popular book in the field of psychology, which directly talked about stock market. In previous two books, researchers or writers had written about the crowd mentality, how they are behaving related to certain financial products or certain financial instrument. But in this particular book, Psychology of Stock Market, Sheldon has specifically talked about the behavior of investors in a particular stock market. So these classic discussions lead to the emotional and psychological forces that focuses on the stock market, or we can say that governs the stock market. And when we talk about the factors emotional and psychological, these factors basically relate to individual investors. So these are the important works which talk about that I have already mentioned. Now what is this related to? While conventional academic finance theories such as modern portfolio theory and efficient market hypothesis, the emerging field of behavioral finance investigate the psychological and sociological issues. So these two particular theories emphasizes specifically to finance and what is going in the specific stock market and what are the rational behavior patterns of the investor. But when we talk about behavioral finance, we are basically focusing on the psychological forces as well as the sociological forces that influences individual investor, a particular organization when finance manager is taking different types of financial decisions, and the group behavior, or we can say the herd mentality of the investor group. So the unique of behavioral finance is the integration and foundation of many different school of thoughts. It is a combination of psychology, sociology and finance. So scholars, theories and practitioners of behavioral finance have backgrounds from wide range of discipline, because if we go through the history, the persons who have developed this particular behavioral finance discipline, they are from economics background, there are persons from mathematics background. So it is a interdisciplinary subject which emerges with the combination of psychology, sociology and finance, or we can say the business domain. So as I already mentioned, the foundation of behavioral finance is based upon psychology, sociology and finance, that is related to commerce or management domain. Now, when we talk about this particular concept, behavioral finance, we have talked about two other concepts, that is Markowitz portfolio theory or modern portfolio theory and efficient market hypothesis. So these two concepts have already been explained in previous lectures. So I think it is clear to you people. So when we talk about Markowitz portfolio theory, we are concerned with two other concepts, that is mean returns and variance. So it is basically a calculated based proposition where investors try to calculate the volatility of the portfolio as well as the return of the portfolio. So here we are majorly concerned with portfolio risk and return. When we talk about efficient market hypothesis, we are talking about three market forms: weak form, semi-weak form and strong form. So in weak form, Pharma has said that in case of weak form, the market reflects all the historical information. So whatever happened in the past, it is reflected on the stock prices. Similarly, in semi-weak form, we are talking about the publicly available information as well as the historical information. So both these type of information are reflected on the stock prices. And in case of strong form, we believe that all information, whether it is historical or public, and another thing is private information, everything is reflected on the stock prices. So investors don't have chances of gaining abnormal profit out of it. So if these two things are correct in a particular scenario, in that context, standard finance is quite sufficient enough to elaborate the mind of the investors. But since these two theories are itself challenging, in case of efficient market hypothesis, we come across that there are certain anomalies in the market which affect these three forms. So information availability is not clear, and because the information is not clearly available, there are chances, or investors behave as these two theories propose, that investors behave rationally. Rationally means we take logical decisions after calculations and doing lots of verification of the data, and on the basis of that we are taking decision. But if this is the scenario, then why these anomalies happen? Anomalies like January effect, bubbles, crashes. Why these things happen? Just because there is discrepancy in the information flow. And in case of Markowitz portfolio theory, it is itself a complicated scenario. We are not able to calculate all the variances, or we can say the mean returns easily, and it becomes more complex for the individual investor. All the fund managers can calculate this particular proposition, but for individual investors it becomes difficult. So these two theories gave rise to the concept of behavioral finance, because there are some challenges associated with these two theories. These challenges are that they are not able to predict what they exactly propounded for, and that's why there exists a discrepancy. So behavioral economist, or we can say the behavioral finance scientist, specifically look into that particular thing. They first started to work on the standard finance theories, and then they came out that there are certain behaviors which are not rational, and investors are not following these two particular concepts which need to be followed as per the standard finance, but they are following certain other things. And what are the other things? They are the emotions, we can say moods. They have different moods, they follow herd mentality, they have their own psychological biases. So these are the things which are affecting the investor, and these things are quite irrational in nature. So there exists a scenario where market is not perfectly governed by the rational investor. There are group of investors, or we can say there are individuals who are basically irrational in their investment decision, and they take decision on the basis of their whims, and they actually affect the stock market. Now coming to what exactly is behavioral finance. Behavioral finance attempt to explain and increase understanding of reasoning patterns of investor. Why the investors behaving in a particular manner. So what we have to understand? We have to understand what is the reason of his behavior. If person is following a particular crowd, then why he is following the particular crowd? If he is emotional, or if he is moody on a particular day of investment, why he is doing so? That is not governed under standard finance. It can be covered under behavioral finance only. So we try to identify the reasons or patterns of the investor behavior, including the emotional processes involved and the degree to which they influence the decision making processes. So what are the emotional processes they are going through? Like mood swings. On a particular day I am not good enough to invest, but I have to invest, and on the bad mood I done my investment. So I am not going through all the data that is available, because I am not in that particular condition. And in that scenario, if I do investment, that become a irrational investment on my part. Another thing may happen that I have set certain heuristics. So on the basis of heuristics, on the basis of certain rules, I am doing my investment. Or I have made some decisions related to how to divide my whole salary. So there are various biases that governs an individual investor, which I am going to elaborate later. So there are emotional processes that individual goes through, and that are actually affecting their investment decision. So I think it is clear that in case of standard finance, when we talking about modern portfolio theory, or we talking about the efficient market hypothesis, capital asset pricing theory, or any other pricing theory, they basically believe that investors should behave rationally. This is the market scenario, and we have to work in this particular manner. We have to go through this calculation, and on the basis of this calculation we are going to form our portfolio. But there are situations that when a particular investor is not in a condition, and it is affected by certain psychological or emotional biases, and because of that he may make a wrong decision, or his decision may be correct, but it is the timing of the decision is incorrect. So essentially a behavioral finance attempt to explain that what, why and how of finance and investing from a human perspective. Till now, we are focusing from the point of view that we have to calculate the stock prices or stock position, or we have to value the bonds. So we are focusing on the pricing of the particular stock. But here we are focusing on the human behavior. Why the particular person, or why the investors behaving a particular pattern. For instance, behavioral finance studies financial markets, as well as providing explanation to many stock market anomalies like January effect, which is not explained by efficient market hypothesis. Similarly, bubbles like retail internet bubble craze of 93, or we can say the dot-com bubble, then stock market crashes of 1987 and 2008. all just because of the human behavior or certain types of biases that particular person is having. Or recently we can talk about the COVID-19. This also related to the behavioral patterns of the investor, where the people get panicked and the stock market fluctuate, and after a point of time when they understand the market situation, then they gain the confidence in the market. So these types of things actually is not explained with the help of standard finance. So behavioral finance try to understand the reason behind these type of patterns that are happening in the stock market. So what the definition? The Huckle has defined behavioral finance as the aspect of finance that uses scientific models to explain how people make financial decisions in real world rather than the theory. So like in standard finance, all the theories are basically the theory. We cannot implement in real life situation because all the theories have certain type of challenges in themselves. So these particular behavioral finance theories can be used effectively if we know about them. So behavioral finance shows how our human psychology influences our financial decisions, and it identifies the consistent, predictable and mistakes humans make while investing. So these are the basic definition that what we have to understand in behavioral finance. We are basically talking about the human behavior. And we are studying this human behavior to know why the particular person in a particular situation behaving in this particular manner. So behavioral finance is a study of the way in which psychology influences the behavior of market practitioners, both at individual and group level, and the subsequent effect on the market. So as we talked about the bubbles, the crashes, or we can talk about the COVID-19 issue, financial crisis of 2008, or any type of effects like anomalies like January effect or week of the day effect or weekend effect. So these are the things where people's psychology basically work, not the standard finance. So what are the basic themes of behavioral finance? Shafrin has provided three major themes, that is heuristics. Heuristics are basically the rules of thumbs on the basis of which individual investors take their decision. So it is not a calculative one, it's just a rule of thumb based upon his own experience. Then framing in the sense how the things are presented before you. So the way the problem or decision is presented before you, it makes you take the decision on the basis of that. Then market inefficiencies, it is related to the outcomes that is contrary to the rational behavior pattern of the market. So as it said that market is perfect and it's efficient. Efficient means all the informations are available to all the buyers and sellers. But in scenarios like present condition, it is not so possible. Now next topic is standard finance versus behavioral finance. So we have already talked about standard finance. In standard finance, certain assumptions have been made. So first go through that assumption, then we talk about the assumptions of behavioral finance. The first assumption is investors are rational as per standard finance theories, whether we take the MPT theory or efficient market hypothesis, CAPM model, arbitrage model, everyone think about that investors are rational. Second, market are efficient. Third, investors design their portfolio as per the dictates of mean variance theory, that means the MPT theory. So whatever calculations or formula has been provided by Markowitz, on the basis of that investors are going to form their portfolio. Then expected returns are a function or risk measured by beta as suggested by capital asset pricing model. So what is expected return are a function of risk. This is off. Function of risk means we have to calculate the beta as propounded by CAPM model. So on the basis of that we are going to measure what is the risk percentage. Then managers are rational and pursue policies aimed at long-term shareholder wealth maximization as per the finance theory. So these theories are basically related to different components of finance. If we talk about investment management or normal financial management, these theories are basically, or these particular assumptions are basically related to different finance theories. So these are the basic assumptions of standard finance on the basis of which it is grounded. Now, what are the biases that has, or we can say, what are the assumptions that behavioral finance scientists has propounded? According to them, whatever has been propounded by the standard finance people, they have criticized each and every assumption. The first assumption, that investors are rational. They said that investors are normal, not rational. Okay, normal in the sense either they behave normally like normal human being, or they behave irrationally. Every time they are not going to use the mean variance model and calculate their portfolio. They can go by the market and what is happening in the market, they can follow that scenario also. Second, markets are characterized by inefficiencies as if it is difficult to beat them. So, the standard finance said that markets are efficient, but they said that markets are inefficient, and that's why it becomes difficult to beat it. Then investors design their portfolio according to behavioral portfolio theory, not according to MPT theory. Then expected returns follow behavioral asset pricing, not the CAPM model or capital asset pricing model, through which we have calculated the beta in case of standard finance. And managers suffer from biases that cause erosion of shareholders' wealth. So there are managers who are not 100% rational. They may be normal, or they may behave irrationally in certain point of time, and their decisions may governed by the biases, and that can cause loss of shareholders' wealth. So on the basis of these assumptions, the whole foundation of behavioral finance has been done, that investors are normal or irrational. We use behavioral portfolio theory, not capital asset pricing theory or Markowitz theory for calculation of returns as well as risk, and there are managers who are governed by the biases also. So now coming to the next important concept, that is behavioral biases. In behavioral finance, the biases has been categorized into two components, that is cognitive biases and emotional biases. When we talk about cognitive biases, they are basically heuristic based biases, or human makes certain types of errors in their decision making. Cognitive errors, we can say. Here we are making cognitive errors. And when we talk about emotional biases, it is basically related to emotions and how these emotions are affecting the investment decision making. So first talk about the cognitive biases. I have taken some selected biases because there are around 144 biases. So you can go through other biases also. So these are certain biases which I am going to explain in this particular lecture. So first one is overconfidence, then confirmation, anchoring, representative, availability, hindsight, and self-attribution bias. So all these types of biases are basically the heuristic bias, and here cognitive errors has been done by the individual investor. So first one is overconfidence bias. Pompian has summarized overconfidence as unwarranted faith in one's intuitive reasoning, judgments, and cognitive ability. So we have seen overconfident people, they believe that they are good about a particular concept, or they know everything about that particular concept. In that situation, they make errorful decisions. So these particular peoples, they are having a particular knowledge about a particular concept, but they think they are more knowledgeable than other people. In fact, in case of overconfidence, it is not possible that people don't have knowledge. They have knowledge, but they have overconfidence or faith on their extra knowledge about that particular concept. So psychologists have determined overconfidence causes people to overestimate their knowledge, underestimate risk, and exaggerate their ability to control the event. So they are the people who said, I can do everything and I know everything about the market. So what type of mistakes a confident investor do? So confident investor overestimate their ability to evaluate a company's potential investment, because they think they know about the particular company, so they behave in that particular manner only. As a result, they can become blind to any negative information about the company, and this situation may affect their investment decision. Then overconfident investor can trade excessively as a result, believing that they possess special knowledge that others don't have. And excessive trading behavior can lead to poor returns to this particular overconfident investor. Next, because they either don't know don't understand or don't heed historical investment performance statistics, overconfident investors are underestimating their downside risk. So what they are believing, that they are confident about the market scenario, or they are very confident about the particular stock because they know about it. Maybe because of their experience, or maybe their past investment. So on the basis of that, they don't want to calculate the risk of the particular company at present situation, and in that scenario they not able to evaluate whether the particular company is more volatile at present or not. So these may be the result causes the downside risk. Overconfident investors hold under-diversified portfolios, thereby taking more risk without commensurate change in the risk tolerance. So, overconfident investors don't even know that they are accepting more risk than they would normally tolerate, because they believe that whatever I am doing or whatever things I am taking into my consideration are perfect. So, they believe in themselves, and because of that belief, they underestimate or under diversified portfolio, and that particular under diversified portfolio may lead to risk, or we can say more losses to that particular investor. Now next one is confirmation bias. And confirmation bias is a particularly a selective perception that emphasizes idea that confirms your beliefs while devaluing whatever contradicts our belief. So if I believe in something, so I am going to have this particular bias. The belief may be that suppose there are rainbows in the sky, I believe that weather will be very sunny or particular thing prevalent in the society. In that situation, my belief, if it is contradicting with others' belief, I am not going to accept it. I just try to confirm that yes, I believe in this thing, and if this situation is going according to my belief, I am going to accept it. So for example, you may believe that more red automobile drives by your house during the summer than any other time of the year. However, this belief may be due to confirmation bias, which causes you to simply notice more red cars during the summer, while overlooking them in other months. This tendency over time unjustifiably strengthens your belief regarding the summertime concentration of red car. So this confirmation bias basically occurs when particular person gets certain types of reaction each and every time, and because of that his confirmations or his belief become more confirmed and is inclined towards that particular belief. So to describe this phenomena another way, we might say that confirmation bias refers to all too natural ability to convince ourselves of whatever it is that we want to believe. So there are the mistakes that can lead to confirmation bias. Because of confirmation bias, what type of mistakes an investor can make? First, confirmation bias can cause investor to seek out only information that confirms their beliefs about an investment. So they may have to seek out the information or the company which they think this particular company is good enough or it is related to my belief, then they are going to invest in that particular company. Another belief that if we see the 52-week high prices are there on the screen, and on the basis of that it confirms our belief about the market, we are going to invest. Confirmation bias can cause employees to over-concentrate in company stock. That means they believe that their company is performing well and they must have a portfolio which consists of the stocks of their company only. Confirmation bias can cause investors to continue to hold under-diversified portfolios because they believe that my portfolio is giving me good returns and I will continue with this particular scenario only. Next comes the anchoring bias. In case of anchoring bias, we focus on certain anchors. So we have certain set anchors, like suppose in case of Standard Finance, we have anchors like we have to calculate the standard expected returns. Without calculating the expected return, if I say I need a 14% return on this mutual fund. So this is the anchor or set belief that I have for a particular portfolio or particular mutual fund, and on the basis of that I am going to do my investments. So in many situations, people make estimates by starting from initial value that is adjusted to the yield to final answer. So the initial value or starting point may be suggested by formulation of a problem, or it may be by result of partial computation. In either case, Adjustments are typically insufficient. So on the basis of what conditions I have calculated that I need 14% from a mutual fund? Either by checking their past history or their performance evaluation or any other thing related to that, I am believing that this mutual fund is going to give me 14% return. So on the basis of this anchor, I am now investing. What might happen? That these might prove wrong in the situation when markets are changing, or this particular 14% or historical 14% return is that scenario when investment is doing good or the particular fund is doing good, but scenarios may change also. I am not calculating that particular thing. So this particular bias occurs. So different starting points yield different estimates which are biased towards initial values, which call this phenomena as a anchoring bias. So these are certain components. Investors exhibiting this bias are likely to be influenced by these anchors while answering key questions like, is it good time to buy or sell the stock, or the stock is fairly priced? We are not able to do this situation or go through this situation properly because we are making our decision based on certain anchors. Now next is representative bias. Representative bias is a cognitive bias where people judge the probability or relevance of an event based on how much it resembles to the specific prototype or stereotype or known pattern rather than logical reasoning or statistical probability. So we are just checking, is it representing our situation or not? If the particular situation is relevant to the, suppose I have experienced some situation and this particular situation is just like that, I am using that representative bias. So representativeness is judgment based on over-reliance stereotypes. The investors' recent success tend to continue into future also. This is one of the representative bias. The tendency of decision of investors to make decisions based on experience is also known as stereotype biases. Then what types of mistakes the investors make? Investors may be too quick to detect patterns in the data that are in fact the random in nature. So they are basically selecting the data and selecting a particular stock based upon the random facts and figures because they believe that it has already happened in past. So this similar pattern may be happen in the present condition also. Investors may believe that a healthy growth of earnings in the past may be representative of high growth rate in future. They may not realize that there is a lot of randomness in earning growth rates. So investor may drawn to mutual funds with a good track record because such funds are believed to be representative of well-performing funds. So there are chances on the basis of representative bias because we are using a particular similar situation and representing the present situation with the previous one. So in that case, we may make wrong decisions. Availability bias. Availability bias is a rule of thumb, or we can say the heuristic or mental shortcut that allows people to estimate the probability of an outcome based on how prevalent or familiar the outcomes appear in their lives. So if the previous thing has already happened and the similar thing is going to happen in the recent present, we are relating with each other. So people exhibiting this bias perceive easily recalled possibilities as being more likely than those aspects that are harder to imagine or difficult to comprehend. So they try to understand the situation which is available to them. That means they have experienced that in past, and suppose something new is happening to them, they are not comprehending to that particular situation. So this is termed as availability bias. What are the mistakes made by the investors under this bias? Retrievability. Investors will choose investment based on information that is available to them, like advertising, suggestion from advisors. So on the basis of that, they are going to take decision rather than having a proper disciplined research they need to conduct. They know that thing, but they don't do because they believe that informations are already available. I just go through that. Categorization. In the mind of people, there are certain categories of company. So they try to follow that particular list only. Narrow range of experience. Investors will choose investment that fit their narrow range of life experience. So whatever experience they have, according to that only they are behaving. They are not following or they are not broadening their horizon of investment knowledge. They are focusing on their narrow knowledge only. Resonance, investors will choose investment that resonate with their own personality or that of the characteristics that investors can relate to their own behavior. So in this particular availability bias, we are basically focusing on the available information or what we already know about a particular situation or our personality, and accordingly we are taking decisions. Hindsight bias, it is propounded by Schiller. Schiller said that it is a tendency to think that one would have known actual events were coming before they happened, had one be present then or had reason to pay attention. So hindsight bias is a term used in psychology to explain the tendency of people to overestimate their ability to have a predicted an outcome that could not possibly have been predicted. So in this situation, if I say I am sitting in this particular room and earthquake is coming, so this is a particular hindsight bias because I am forecasting something which is not possible without a proper calculation or proper knowledge. So in this particular bias, people tend to overthink about the particular situation, and on the basis of that they take certain decisions. They estimate, or they can say they overestimate their power of knowledge, and they believe that I have the ability to know the future very well. Then self-attribution bias. Self-attribution bias is a cognitive phenomena by which people attribute failures to situational factors or success to dispositional factors. That means if I am successful, it is because of me, and if I am unsuccessful, it is because of the bad luck or external factors. So there are two components. Self-enhancing bias, it represents people's propensity to claim an irrational degree of credit to their own success, that is dispositional factors. And self-protecting bias represent the corollary effect, that means irrational denial of the failures, and the failure is just because of the external factors. Now coming to emotional biases, there are loss aversion, regret aversion, endowment, status quo, mental accounting, herd behavior and optimism bias that has been covered under emotional biases. So loss aversion refers to the phenomena where real or potential loss is perceived by individuals as psychologically or emotionally more severe than the equivalent gain. So for example, if I am losing $100 or 100 rupees in a particular bet, it will be more painful for me if I gain $100. So if we compare $100 gaining or $100 profit and $100 loss, the loss will be more painful for me. So I will not take this proposition. So it's an emotional bias where we focus on the emotions that are attached to a particular investment. If I am losing something, I am focusing on that. I am not focusing on what I am gaining from that particular investment. So in the fear of loss, I am not going to invest. Regret aversion bias is similar to that particular loss aversion bias here. I am not investing because I want to avoid the regret of having that loss. So why should I invest? I should invest either to gain some money, or if the situation is not proper or it's not up to the mark, in that situation I lose money. But the losses are more painful to me in case of loss aversion bias. In case of regret aversion bias, I am just trying to avoid this particular situation of winning or losing a particular game or particular bet. So regression aversion bias is a psychological error that arises out of the excessive focus on the feeling of regret at having made a decision, which turn out to be poor mainly because the outcomes of alternatives are visibly better for the investor to see. So we know that what is going to happen, and still we are not focusing on this. Endowment bias is described as mental process in which differential weight is placed on the value of an object. That value depends on whether one possesses the object, and faced with its loss, whether one does not possess the object, has a potential to gain from it. So what I am doing, I am processing through the mental panic that if something happens, or what will be the situation, if something don't happen, what will be the situation. So I am giving differential weights to the different situation. So if one loses an object that is part of one's endowment, then the magnitude of this loss is perceived to be greater than the magnitude of corresponding gain the object is newly added to it one's endowment. So if I adding a particular thing in my basket and I am losing thing, that is more painful, and if I am gaining, I am not focusing on that. Status quo bias, it is propounded by William Samuelson and Richard Jacoser. They said that individual persons like to maintain their status, or they need to be in a status quo, the position in which they are in present. So they try to relate to the investments or decisions which are related to that position only. If that position is affected, they are not interested in that particular bet, or we can say that particular investment. Mental accounting, it is propounded by Richard Thaler. According to him, it is a set of cognitive operations used by individuals and households to organize, evaluate and keep track of the financial activities. So what we do, we try to have certain baskets for individual expenditure. So we have household expenditure, grocery expenditure, traveling expenditure, similarly investment and other things. So we try to divide our expenses into different, you can say different baskets or different compartments in our mind only. We are not doing it in physical way. So individuals tend to assign different functions to each asset group, which has an often irrational or negative effect on the consumption pattern of the investor, and it may affect their decisions also. Then herd behavior is a quite common behavior. Herd behavior is just following the crowd. So why people are following the crowd? They want to imitate what others are doing. We can simply say that it's an imitation what is happening in the market. So if my friends are doing this particular thing, I need to do that. If my friends are following a particular investment pattern, if I don't know about the market and how to invest, in that situation I follow his path. So there are cases, the crashes, the manias and panics we can say, just because of the herd mentality. Then optimism bias, it refers to tendency to overestimate our likelihood of experiencing positive events and underestimate our likelihood of experiencing negative event. So we are optimistic about the situation. So if the situation is related to positive belief, then we go for it. If it is not, then we don't go for that particular situation. So these are two categories of biases. There are cognitive errors and emotional biases which governs the investor. And if the investor control these particular biases, they can be in a better position. So how they can control it? So what are the strategies overcoming these biases? First one is increase awareness. One should know about what is happening in the market, as well as they should know about their own biases, and accordingly they should invest. Structured decision making, decisions should be made based upon proper calculation, not on the basis of heuristics or certain types of emotional biases. Slow down in the sense, at the time when the market is uptrending or the volatile, we need to slow down and understand the market, then go accordingly. Just following the herd behavior, it's not a good for a particular investor. Group input, if you don't know about the market situation and if you are not known to market, in that scenario it is important that take advice from your friends and advisors so that you can better invest into the market. Accountability, it's your own accountability what you have done. It's not the fault of broker or advisor or your friends. It's your knowledge. It's up to you how you can enhance your knowledge. So it's your accountability what your investment is doing, and if your investment is not performing well, you need to work upon it. Behavioral techniques. So there are certain behavioral techniques are available, like we need to understand how we can control these emotional biases, and on the basis of that we can rework on our investment decision. Leverage technology, we can use recent technologies like robo-advisors and AI to take advice from them. If we don't feel taking advice from financial advisors or our friend circle, in that scenario we can use technologies which can help us in better manner. Reframe perspectives. In case of problems, we need to reframe it. Just going by the market condition or just going by the market saying it's not good. We need to understand the market behavior patterns and we need to work upon our investment strategies. Then growth mindset, one should have a growth mindset so that they can earn a good amount of profit from the market. And for that, they need to rework on their strategies. Scenario planning, if something bad is coming or if something good is coming, they need to understand the market beforehand and then rework upon it. So with this, we can control our biases. An individual person whoever is investing in stock market or any type of financial instrument need to work upon their biases, understand it first, then rework on that biases and try to have a better investment decision. With this, I conclude this particular chapter. Thank you.